In today's video, we're going to take a comment that we've seen in one of our past videos. And again, this is the importance of making sure you comment on these videos because we will do videos on them and ensure that we can make the content specific to you all watching this. But the question is on the screen there and it reads, can you do a video on a pension with a PLOP option versus choosing a survivor benefit, also using a PLOP strategy to lower annual fixed taxable income to allow room for more Roth conversions? And they mentioned that they have OPERS. And so because of that, we're going to do just for you. And OPERS is a pension here in Ohio specifically. We have clients all across the country. We actually have just as much clients coming to us out of the state of Ohio as we do in the state of Ohio at this point, and are more of a national firm. And obviously the pension options are going to be different everywhere you look, but you'll see that there's a lot of similarities between all the pensions, and we've seen a lot of pensions during all the years. But we're going to break down a situation with one of our clients of what options they had and what we ended up choosing for them and why we came to that decision. So I think this will give you a really good understanding of what to do for your specific situation as you look at the options and make sure you're making the right decision.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So if this is your first time watching this video, or maybe that you've been watching this video for a long time now, you know who we are. You know that we focus on those with pensions and those with 1 million or more saved. And we call these folks the Midwestern millionaires, the hardworking people. They're frugal, they're diligent savers. They've done all the right things over all these years. And we also consider them in the 2% club because only 20% of people have a pension. Only 10% of people have over $1 million saved. And so when you combine those two percentages, you're left with 2% of the population, which is a very strong niche that we focus on here with this video and with our firm to make sure we can deliver the most value to you. So if you've been struggling to find content on YouTube on pension options, this is the channel for you. We've got a plethora of pension videos that you can go back and watch, and we post new videos every week to make sure that you get everything you need to fruitfully live that retirement, because we know that you've worked a long time, you've worked very hard, you've been a diligent saver, and now's the time that you're going to need some more advanced planning to make sure you're maximizing your options. And obviously when it comes to these options with pension options that you have to elect when you retire, these are irrevocable decisions that you can't get back. And so we need to make sure we run all the numbers and make sure we make that decision. And when you ever do this, never guess on what you should take. Never do what your buddy told you, never do what your friend told you. Always make sure you run all your options, and then from there, decide what is going to work best for your situation, because everyone's pension options are going to be different. It's going to depend on your age, it's going to depend on how long you've worked, it's going to depend on what kind of pension you have, it's going to depend on if you have a lump sum option or a partial lump sum, what are the survivorship options, what's your health, what's your spouse's age, what's your spouse. So there's all these combinations, and that's why people get so confused on it. And that's also a big reason why people work with us. And if you are looking to make this pension decision and you're not comfortable doing it on your own and you want to work with a team ongoing that's going to help you with decisions like this and more advanced tax planning with pensions in retirement, you will have the opportunity to schedule a time with our team by going to the link below and clicking on the link to schedule a 15-minute call with us. And I always try to preface that we can't serve everyone that reaches out to us, but we can try to reach as many people as we can. And right now we're only bringing on about 10 to 12 clients to really ensure that we don't lose the focus of the clients we do have and ensuring we deliver a very high level of service to not only them, but all of those that we commit to bringing on. We're not a firm that just tries to serve everyone. We are boutique and making sure we can give the best experience. And so we'll make sure if we can help you, obviously we can start a relationship. If not, we'll try to point you and guide you in the right direction to make sure that is the most fruitful call for you possible. And so on today's video, we're going to break down a real life example here with one of our clients, and we're going to walk you through all the options. And so if you see up here on the screen, you're going to see all the options that they have here. And obviously we remove their names because we don't want to share any confidential information here. And again, remember, this is going to be different for everyone. But let me just walk through what this all looks like. So you can see their date of birth for not only the primary person that has the pension, but also the beneficiary. So that's going to be important to know when calculating those survivorship options of what those calculations are going to be for this specific pension. And then you can see here that there's a termination date, that we had set when we ran all these numbers here. And obviously you can see on the bottom here of all the numbers. And this is where it really starts to get confusing. And for us, we love this puzzle. We love putting together these pension option puzzles. That's why we actually have this niche here. As I started with a company that specialized in serving retired military and federal employees. And I just thought that planning was so unique and not enough people talked about it. But it also required a lot more, in my mind, stimulation and work to make the right decisions. And so for us, we're a little nerdy here at Peak Retirement, and we enjoy these calculations. And we have the exact software that we've actually built ourselves to help us make the right decisions here. It's hard to find that type of software in the industry, with a lot of advisors not really focusing on this area. So this is something we've actually built out ourselves to make sure we're maximizing these decisions of taking the survivorship, taking the PLOP, taking the lump sum, to help make sure we're making the right decision. So basically what this option looks like is they could elect to get basically if they take single life, which means there's nothing that goes to the spouse, and if they elect to take a lump sum or no lump sum option, the most that they could get per month from their pension is $7,900 a month. That's a lot of money. That's an awesome pension. That's, close to $100,000 a year there, and they're going to be pretty excited with that pension for the rest of their life. Now, if they start to say, hey, I still don't want to give anything to the spouse because they're going to be taken care of, but I want to take the maximum PLOP option. So with this particular pension plan, there is no full lump sum options. There's only partial lump sum options. So the most that they could get in their pocket is $286,000. And we're going to dive in further into all these options to see which one's best, but that's what it would be. And if we do that, then we're only going to be able to get $6,300 a month ongoing, because obviously we're going to get a reduced monthly amount to take the lump sum. So something we're going to be looking at in this video is, should we take that lump sum knowing that we're going to drop our monthly income by, what is that, about $1,600 a month? That's a lot of money to lose per month, but we do get $286,000. So what's the value there, and what should we look to do? So we're going to break down those numbers for you. Don't worry, stay tuned. And then, if you look at the other options, let's just go to the maximum survivorship option of joint life and 100%. So this means that the spouse would get all of that pension payout. They would get, in this example, if you look on the right there, $6,858 if that spouse passes away. So in this case, these are great options to take if that spouse dies tomorrow, because if they pass away tomorrow, then that payment to the spouse is going to continue for the rest of their life, and they only had to technically pay for it for 1 year, right? Because once you pass, the money goes along. So the consideration here is, what is the cost of the survivorship option is really what we want to keep in mind. And so obviously the cost is you only get $6,800 instead of $7,900. So you can see that's about an $1,100 cost per month in order for that spouse to get the money. So here's the considerations to see if this is worthwhile for you or not. One is understanding the fact that if your spouse passes first, you could end up paying for this for a long period of time without there being money to go to that spouse. And so it's almost a sunk cost at the expense of you having a lesser payout. So that's a concern. Now, as I mentioned, if you pass away tomorrow, it could be an awesome opportunity, an awesome deal to do that. But what we're going to talk about in this video is how maybe do we be more flexible with the decision of maybe not having to take the lump sum. Maybe we can use that $1,100 in a more productive way, whether that's life insurance, or maybe that's just more money in our pocket now, knowing that we can self-insure from all the investments we've saved over all the years, or maybe our spouse has a pension that they're going to be comfortable on if you pass away. So we never want to leave the spouse hanging. That is always one of the first decisions we make, is to ensure that spouse is going to be good to go if we do not take the survivor. Because if that's not the case, we're going to take it almost not always all the time, because we can't leave a spouse vulnerable if someone were to predecease and pass away early. So those are the considerations of these pension options. And you'll also see they have the option of doing 100% joint life with also taking a PLOP, so they could get both benefits in both considerations. And that would kind of be, in my mind, making sure you have the maximum death benefit, if you want to call it, for that spouse, because if you pass away tomorrow, they get $5,600 ongoing, but they also get $246,000 as well. And so, deciding to take that versus taking the higher pension payment of giving 100% is a decision that has to be made as well. And you can see the 50% and 25% options there that they could do as well. And so let's start breaking this down and thinking, what is going to make sense here. And so really the biggest decisions we're trying to make here is, one, if we take the PLOP, can we get a higher income in a different way than what we could get there? That's one of the biggest things that we decide on if we're going to take that PLOP. And so let's look at this and detail out all of the decisions that we need to factor in. So if they take $286,000 lump sum, they're going to lose about $1,600 a month, which is about $19,000 a year. So we need to see, can we do something better with this $286,000. And so let's just do some math. If this pension owner is going to live till, let's say 83, which is life expectancy for them, then that's another 25 years based on this scenario. If we were to take out $19,000 a year from that money and we need it to last 25 years, then we need that $286,000 to grow to $478,000. Now you're probably wondering, well, that's a big return that we need. Well, over a 25 period time, it may only be like a 2.1% interest rate is when we run the calculation. So, can we expect to self-invest that money and get better than a 2.1% interest rate? I would say that's very likely that you could get that. And so not only could you provide the same amount of income that the pension provided, but also if you pass away at any time before that, there's a lump sum to go to your spouse or your loved ones more than what you had. Or you have more flexibility that maybe early on in your retirement, you wanted to take this lump sum and pay off some debts, or you wanted to use it on a big trip or home improvements that if you take the pension option, you're stuck. You can only get so much per year for the rest of your life. So that could be a consideration of why the lump sum could make sense from a math scenario. Or maybe you're thinking, I really like the idea of getting a guaranteed payout for the rest of my life. Well, maybe you could look at taking that $286,000 and put it into maybe another type of vehicle with an insurance company, like an income annuity that could pay you out a guaranteed stream of income, potentially more than what that pension option could offer. And sometimes that's the case, sometimes it's not. You just have to shop out all the best rates and all the insurance companies if that's something you want to do. And one reason why people would do that is, one, to get a higher payout, but also if it's with an insurance company, there could be a ability to have whatever's left in that amount, that $286,000, if you pass away tomorrow, then that could still pay out to beneficiaries, whereas with your pension, if you don't take the lump sum, that's not going to go to your children, as an example. So a lot of people like that option of it. And if you even think about potentially getting some more return in this type of lump sum, reinvesting it scenario, we don't want to be too aggressive in our scenario and running too high of numbers, because we don't want to take on too much risk in most cases with the clients we work with when taking this lump sum option, because we have to remember it is a guaranteed option if we leave it where it is. And so, we are going to show you options that if we get a 4% interest or even a 5%, we can turn that $19,000 a year of income into potentially $30,000 a year. So we can get them an $11,000 increase if we can get a 4%, which on today's marketplace, you could find a 4% guaranteed rate and likely lock it in for some period of time to take advantage of that type of opportunity. And you can even find 5% options out there that can lock in for a period of time. And if we can do that over a 25-year period, then you can increase from a $19,000 a year payout to up to a $39,000 a year payout, basically doubling the amount that your pension option would have gave if you'd taken the lump sum. So again, these are projected amounts here. You want to make sure you have a specific plan in place and know all the pros and cons when you make these decisions. This is not a recommendation to take the partial lump sum in all cases. There's times when we tell clients to not take the lump sum. The key is to run your numbers, understand your scenario, and understand your options, then make the decision with a trusted team that you're going to make the right decision. Because remember, you can't change it, it's irrevocable. And so that was one of the decisions that we had to make, and they did end up choosing to take that PLOP in this scenario because they wanted to have that benefit that if they were to pass and also have more flexibility with the income, and so they felt that was best for their scenario. And we looked to use that PLOP and put it in more of a protected vehicle versus something that's in the stock market, because they were thinking, hey, if this is already going to be protected, I want to make sure it's still protected, just with more options. So that's one scenario you can look at. Now the next scenario that we had to make a decision of what are we going to do for the spouse? Are we going to take 100% survivor? Or are we going to take none? What does this look like? So let's show you the numbers of what we decided. So as we discussed in this scenario, we can take almost $8,000 a month and have a single life, no payout to the spouse. That's a pretty good benefit. Or we can elect the 100% survivor option, which is going to bring us down about $1,100 a month that we're going to have to pay for in order for that spouse to have that payout for the rest of their life. And obviously, as we know, that's a cost that we could pay ongoing, as we've already talked about. And so this is where we're going to do a life insurance analysis to see if it makes sense. So let's first start off by doing an analysis to see what is their income need if we want to match just what the 100% survivorship option is. And so whenever we make recommendations for clients in this scenario, we never want to give them less. We're only going to recommend not taking a survivorship if we can explore it and see that it's reasonable to either provide the same amount or more coverage for that spouse if you were to pass away tomorrow. We always want to think worst case when doing survivorship planning. And I always tell our advisors when we do this type of planning, we never want, Bill and Jane to have Bill pass away and Jane has to go back to work, or Jane's going to not have enough money and Jane has to live on less. That is one of the most painful things that we would ever think about happening as a trusted partner with this family. We need to ensure that when Bill passes away, that Jane is going to make sure that she has everything she needs and not having to worry about the financial side. She's already got enough to worry about in losing her loved one. And so we always need to make sure the plan works for worst case scenario. And then if they pass away 5-10 years ago, icing on the cake, they're even in a better situation. There's no worry. So that's one of the biggest points of this type of planning. So let's look at it for this case. So if we just ran an analysis here to see how much would we need, and we ran this over a 30-year period, if we were to have that payout 100% go to that spouse, what would be the total amount of value that pension would be worth if they lived another 30 years from passing away tomorrow? And our calculation showed that would be about $1.277 million there that they're going to have if they had that $82,000 a year and had a 5% growth rate on that money over time. And so again, you could consider that a little more aggressive if we are a little more conservative. If we wanted to show even a lesser return on that money, maybe a 3% or 2% as we showed earlier, then we probably don't need a $1.277 million amount there. Or if we're expecting to get a higher growth rate, which again we wouldn't do, then we may not need as much of a death benefit if we were to go this life insurance route. But again, we always want to plan conservatively, so 5% seems like a pretty reasonable number to plan for there. And so the other thing to understand is that we don't need $1.277 million forever, because each year this spouse lives, then we're going to need less of a need for the other spouse. And so that's why when we typically do this type of analysis, we need to understand how much we're going to need for the first 10 years if they pass. How much are we going to need if they pass away in the first, after the first 20 years? Because remember, there's 20 years we don't have to plan for anymore, right? If they have a 30-year life expectancy and they've made it 10 years, we only have 20 years left to live, which means we're not going to need a full $1.277 million at that point. So that's why when we look at this type of analysis, we want to look to layer on life insurance where we may not need permanent coverage for all of that, because we're always not going to have that much of a need. We may be able to do a 10-year term, which can be a lower cost, and layer that on with a 20-year term, which again may be a little more than a 10-year, but not as much as a permanent. And then maybe we just have a smaller amount of permanent to get us through anything over the next 20 years that we may need to get us to that life expectancy number that we're expecting. So again, that's why it's important to be strategic, but also work with a professional team who understands how to make these decisions and has the software calculations to help you decide if this is a route you want to go. And also, I didn't do a disclaimer, you have to be healthy enough to get the life insurance is something we consider. So maybe you're in bad health and not even eligible. This may not even be an option you can look at. It still could make sense for not to take survivorship, but maybe that's more of a reason to take survivorship option if you can't get life insurance, if you're likely going to pass away first. Maybe your spouse is younger than you as well. Those are all considerations that we want to factor into this decision. And that's another reason why this isn't a one-size-fits-all decision. People ask us all the time, should I take the lump sum or not? We're on a 15-minute call. We can't do anything until we run a 20-hour plus plan to run all these numbers, scenarios, to make sure you're not missing anything. And if someone ever gives you cookie-cutter advice like that, you want to be very careful, because there's no non-negotiables in financial planning. Everyone's different. Everyone has different goals. Everyone has different situations. It's all going to be about how does it play a part for your specific situation. So let's think about this. So if they need $1.277 million for the next 30 years, we ran our calculation, well, what if they lived 10 more years? How much do we need for the next 20 years? And it's about $1 million. So we're going to use up that amount up front. And so we need $1 million for the next 20. And then for the last 10, we need $600,000 is what our calculation shows to make sure that we can make this work. And so I'm going to show you how all this plays together. So what we ended up doing for this couple is we needed about $1.25 million in coverage, as we talked about. And so we're going to layer this with a $250,000 10-year policy. We're going to layer a $500,000 20-year policy, and then a $500,000 permanent policy. So this is going to make sense when I put this all together. That all equals $1.25 million in coverage. And as you see, we have all the coverage we need for the first 10 years, and then all of a sudden we need less money then. And so now that $250 drops off if we still live past that time. And now we have $1 million. But remember, $1 million is all we need based on our calculation to get by for the next 20 years. And then we live another 10 years, and okay, now we drop off $500,000 of coverage. So I know it's no fun dropping off the coverage that we never use, but again, it's insurance. That's what it's there for, is to make sure that if we did need it, it's there, but hopefully we don't need it. And then for the last 10 years, we have that $500,000 of permanent coverage that's going to get us by for what that needed amount. And so you can see this is just a rough estimate of how all that works. And so the grand idea here, though, is like, what does this cost, Joe? Is this going to cost me more than $1,100 a month to just take the survivorship? Why would I go through all this if I can just do that? And well, for this couple, when we ran the numbers, to do all of that would only cost them $800 a month compared to the $1,100. So they actually be saving money, getting the same amount of coverage, but having way more features and benefits that are going to make sense for their situation. So again, just making sure you run your numbers is what's going to make the most sense there. And also keep in mind, if we decided to also take the lump sum option, then we may not need as much of a life insurance benefit, because that could be counted as a life insurance policy as well. So that needs to be factored in to the equation, as well as how all these decisions are going to play a part. So hopefully this gives you a really good understanding of how this works and how this all plays together. If you are looking for specific help on your pension options very similar to this situation, you're just thinking, I don't have the software, I don't have the time, I don't have the expertise, I don't want to have to worry about this, reach out to our team. This is what we do with our clients. We help them make these decisions, and we help them with more moving forward. And there'll be a link below in the description that you can schedule a time with us. And again, this is what we primarily do with our clients. Million plus with pensions. This is the type of planning we do, and we've built out our whole process and firm to be able to serve these people extremely well while giving them that boutique experience. So hopefully this case study was helpful for you. We'll see you on the next video. Joe Knows Retirement, and I hope you have a great day.